Howdy, Jacob here. Today we're looking at Ceco Environmental Corporation in the machinery industry. Just under a billion market cap, just over a billion enterprise value, under a billion. And I do like to look at insider ownership, and we're seeing 17% insider ownership. That's great. So management has a lot invested into the business. They'll likely do what's best for you as a shareholder, as they themselves are pretty heavily invested into the business. So they have been founded in 1869. They've been around for a minute, huh? Revenue growth, very impressive, over doubling over the last 10 years. Gross margin down a little bit, operating margin down a little bit. Not as exciting. Haven't paid a dividend since 2017. We'll see where their capital allocation is going. Return on invested capital, pretty poor. Balance sheet has 55 million cash on hand, 13 million short-term debt, 127 million long-term debt. That, let's say, $100 million long-term debt is, of the recent year, nothing. But we'll see whether these acquisitions are really creating that cash from operations or not. But free cash flow has jumped pretty heavily since these acquisitions, so they might be pretty solid acquisitions. Otherwise, there's no other use of cash flow. I mean, I guess buying back a tad of shares, but not even enough to, or pretty much enough to just offset stock-based compensation. So this will be, let's start making some assumptions. This will be a little bit interesting. So growth has been crazy from these acquisitions that they've made. I think if we average it out, I'm going to leave capital allocation to acquisitions since they've done that historically. I think with solid acquisitions, maybe they're growing at 6% a year. I do like to base my P and price free cash flow off of organic usually, unless it's historically seen that acquisitions are really bringing a lot to the bottom line. I might just do market average there. Pretty much market average. For margins, free cash flow being so much higher really makes me happy. Let's do 4 and 5% with offset stock-based compensation. So this is assuming no dividend payment for the last 6 years, 7 years or so. I'm assuming a good amount of capital allocation going towards acquisitions since they've done that in the past. A little bit, maybe 5 to 10% to debt reduction, but and then 5 million a year or whatever to offset stock-based compensation. So majority of their money is being invested into acquisitions. Maybe 7% is more reasonable there, but based on their margins going down, their return on invested capital in the mid single digits, I'm just not really convinced this is a above average company. And growing through acquisitions is tough because, one, growing organically, it's easier to see what the numbers have done, and two, when you really start buying back or you buying a lot of companies, you just start caring about hitting revenue and not necessarily the bottom line, which is what I care about. Free cash flow. Give me gushing free cash flow. If you're making an acquisition, you better produce a heck of a lot more free cash flow than what you're buying it for. Well, not literally. I'm saying if you buy a company for $1 billion, it better be making 100 mil plus in free cash flow. Or it better be, inadvertently making 100 million by making other processes more efficient. So for me right now, 79% drop before you get the return I'm looking for here. I'll definitely be waiting a minute before it gets there. So I will be researching other companies in the meantime that are hopefully better and more appropriately priced. Hope you enjoy the video and have a great rest of your day. Thanks.